Please like, share, and subscribe. Wishing you happiness and good luck every day.
You know, when you think of the greatest investor of all time, one name probably pops into your head: Warren Buffett. We all admire the guy, but let's be real. How many of us actually follow his advice? So what we're going to do here is distill the core of his winning strategy from the book Think, Act, and Invest Like Warren Buffett, and turn all that wisdom into a simple, actionable blueprint that you can actually use.
Okay, let's just be real for a second. Take a look at this. Does this feel a little too familiar? That feeling, that rush of greed when everyone's making money and you just have to get in. So you buy at the absolute peak. And then, the panic. That icy grip of fear when the market turns and you sell everything at the bottom. It's this destructive loop, and it's the exact opposite of how Buffett invests.
And this is where things get kind of crazy. And Buffett points this out himself. He says, look, it should have been so easy for investors to make great money. All you had to do is just ride the wave of American business in a low-cost, diversified way. But that's not what happened, right? For most people, it's been pretty mediocre, or even a disaster. And that is the core problem we're going to tackle today.
All right, so here's our roadmap for today. First, we'll dive into this paradox of why so many investors fail, and we'll pinpoint the 3 biggest mistakes they make. Then, we're going to shift gears and really learn to think like Buffett himself. After that, we'll uncover this idea of the winner's game that he talks about. And finally, we'll put all the pieces together so you can build your own financial blueprint. If you stick with me, I promise, by the end, you're going to have a super clear path forward.
Okay, let's kick things off with Section 1, the investor's paradox and 3 big mistakes. This is where we get to the heart of why we all say we admire the master, but then turn around and pretty much ignore everything he says.
So let's talk about the first big mistake, and trust me, this is a huge one. It's this belief that you, or some superstar fund manager you pay a ton of money to, can consistently outsmart the entire market. You know, picking just the right stocks at just the right time. This is the game that Wall Street just loves for you to play. But should you? And Buffett's take on this? It's a hard no. And what I love about this quote here is how he says it, the know-nothing investor. He's basically saying that if you just admit you don't know where the market is going and you buy a simple, low-cost index fund, you are almost guaranteed to beat the actual results of most of the pros. And the reason is so simple: costs. Those high fees eat away at your returns year after year. All right, that brings us to mistake number 2. You know what I'm talking about. You turn on the TV, and it's just a constant barrage of so-called experts telling you the market's going up or it's going down or sideways. It feels like you should be paying attention, but is it actually helping you? And Buffett's take on this is, well, it's just absolutely brutal. And kind of hilarious, to be honest. He literally calls market forecasts poison. He says they tell you a whole lot about the person making the prediction, but they tell you absolutely nothing about the future. It's not valuable information, it's just noise designed to make you do something.
And look, this isn't just Buffett's opinion, right? The actual data, the research on this stuff is just crystal clear. The skill of economists at forecasting is basically a coin flip. They're the most wrong at the exact moments you need them to be right, like right before a crash. And get this, the more famous they are, the worse their predictions tend to be. How wild is that?
So, if you're listening to all these forecasts, what's the next logical step? Well, that leads right into mistake number 3, trying to time the market. You get scared by a forecast, so you sell. Then things look good, so you try to jump back in. It seems like it should work, right? But can anyone actually do it consistently?
And wow, this quote really paints a picture of what happens when you try. He basically sees the stock market as this giant machine, and its only job is to take money from the people who are always busy, always reacting, and give it to the people who just sit still. He says that for most people, inactivity is actually intelligent behavior.
So when you put it all together, what's the big takeaway? These 3 mistakes, trying to be an active stock picker, listening to forecasts, and timing the market, they create this thing called the behavior gap. And you can see it right here. It's that painful, frustrating difference between the return your funds are earning and the much smaller return that actually ends up in your account. The bottom line, the biggest enemy to your portfolio is probably you.
All right, so we've spent a lot of time on what not to do. Now, let's flip the script. Section 2, thinking like the Oracle. And the big secret here isn't that you have to be some kind of genius. It's got nothing to do with IQ. It's all about having the right temperament.
Okay, this right here is such a critical concept to grasp. Most of us operate with stage 1 thinking. We see a crisis on the news, we get scared, we sell. simple cause and effect. But Buffett uses stage 2 thinking. He sees the same crisis, let's say the 2008 financial meltdown, but then he asks, okay, what happens next? How are governments going to react to this? He anticipates the massive response, the bailouts, the stimulus, and he sees the incredible buying opportunity that everyone else's panic just created.
Now, this next idea is a little more advanced, but it is absolutely key to understanding how markets work. It's not good news or bad news that really moves stock prices. Why? Because the market is smart. It already knows the news is bad. That's already baked into the price. What really moves the needle is surprise. It's when things turn out to be way better or way worse than everyone was already expecting. And that's why just reacting to today's headlines is a total fool's errand.
And all this thinking, it naturally leads us right here to Section 3, the winner's game, also known as passive investing. Let's dig into why doing less, so much less, actually ends up doing so much more for your money.
I mean, this image just says it all, doesn't it? The evidence, both from academics and the real world, isn't just kind of leaning towards passive investing. It is overwhelmingly, crushingly in its favor. Among people who really study this stuff for a living, this isn't even a debate anymore. The science is settled.
And the reason why is just simple, undeniable math, figured out by a Nobel Prize winner. Think of it like a pie. Before you pay anyone, all the investors together, the active pickers and the passive indexers own the whole pie. So on average, they have to get the same return. It's a zero-sum game. But, and this is the big but, the moment you factor in costs, the whole picture changes. It becomes a loser's game for the active crowd. Just look at the simple math. The passive investors have super low costs, so they keep almost all of their slice of the pie. The active folks are paying for fancy managers and tons of trading. That eats away at their slice. It's not magic. It's just arithmetic. The average active investor must underperform the average passive investor.
All right, so the theory is rock solid. We get it. But what do you actually do? How do you build this thing? Let's get practical in Section 4, building your financial blueprint. This is where the ideas become a real portfolio.
So, let's walk through how to build a portfolio like this. The big idea here is smart, global diversification. You can start with a really solid basic portfolio, like 60% in a US S&P 500 fund and 40% in bonds. Great starting point, but we can make it even better. Next, we can add a slice of US small company stocks for some extra growth potential. Then, maybe we tilt it a little more by adding US value stocks, which have a great long-term track record. And finally, the really important part, we go global. We add international stocks so we're not just betting on one single country. See what we're going? We're building a much stronger, more efficient portfolio.
And don't just take my word for it. Look at the actual numbers here from the book. That simple, basic portfolio did great, earning 10.6% a year. But the more diversified one, it earned 12.4%. I mean, that is a massive, massive difference over time. And here's the kicker. It got those much higher returns with barely any extra risk. That, my friends, is what they call the only free lunch in investing.
So, as we bring this all home, it really comes back to this one central idea from Buffett. The entire game plan we just laid out, avoiding the big mistakes, thinking with a level head, building a simple, diversified portfolio, none of it requires a genius-level IQ. It's all about emotional control. It's about keeping your cool when everyone else is losing theirs.
And that really leads us to the final question, the one that really matters. Look, the ideas we talked about today are simple. They're not complicated. The proof is overwhelming. But simple doesn't mean easy. The hardest part is having the discipline to stick with your plan when every fiber of your being is screaming at you to do the opposite. So the question isn't, does this work? We know it works. The real question is, for you, do you have the discipline to win?
Welcome to The Explainer. Today, we're digging into the wisdom of Warren Buffett, who is, pretty much always called the world's greatest investor. But here's the thing, we're also tackling a huge paradox. If everyone agrees his advice is pure gold, why do so few of us actually follow it?
I mean, seriously, if you ask almost anyone this question, whether it's a Wall Street pro or just someone on the street, one name always, and I mean always, comes up.
That's right, the Oracle of Omaha. The guy is universally hailed for his incredible, mind-bogglingly successful track record. There's really no debate here. He's the guy. And that right there is the big mystery we're digging into today. If we all agree he's the best, the one person whose advice we should probably listen to, why do so many of us actively do the opposite?
Why do we do the very things he spent decades warning us against? Okay, so here's our game plan. We're going to look at Buffett's core advice on a few key things: passive investing, why you should ignore all those forecasts, and the trap of market timing. Then we're going to zero in on the single biggest, costliest mistake that most investors make, and it's all about our behavior, and then show you a really simple strategy to start acting a bit more like him. Let's do it. All right, let's kick things off with Buffett's first big piece of advice. This one tackles one of the oldest debates in finance. Should you be an active or a passive investor? Now, his advice here is so simple, it's almost hard for people to believe. He basically says you don't need to be some stock-picking genius to win this game. In fact, he thinks that by just admitting you don't know what's going to happen and investing that way, you can actually end up beating most of the so-called experts, the ones who get paid a fortune to know. You can really see the huge difference in philosophy here. Active investing, well, that's a constant game of trying to outsmart literally everyone else. You're picking stocks, timing the market, jumping in and out. It's all based on expert forecasts and comes with some hefty fees. Passive investing is the complete opposite. It's about saying, you know what? I'm just going to match the market's success, buy and hold, pay almost nothing in fees, and just tune out all the noise. And here's the real kicker. Buffett is convinced that the high fees and trading costs of active management are just a massive drag on your money. He says that by simply picking a cheap, broad index fund and just leaving it alone, you are statistically sure to beat the results of most of the pros. It's a pretty bold claim. Okay, so that brings us perfectly to his next big piece of advice. And honestly, this one is a really tough pill for a lot of us to swallow, especially today when we're just bombarded with information 24/7. And his advice is ignore the experts. Ignore their forecasts. Yeah, Buffett really doesn't pull any punches here, does he? He literally calls the endless stream of market predictions poison. He says it should be locked away where no one can get to it. Not just kids, but adults who act like kids when it comes to the market. The ones who panic and act on every single prediction they hear. And look, this isn't just some wild opinion from Buffett. The research on this is crystal clear. Study after study shows that expert market forecasts are basically a coin flip. Even worse, they're the most wrong at the exact moments you need them to be right, like right before a big crash or a big rally. And get this is my favorite part. Research shows that the more famous a forecaster is, the less accurate they tend to be. How crazy is that? The writer Carl Richards came up with this brilliant, super simple question to kind of short-circuit our own worst impulses. Before you rush to sell everything based on some guru you saw on TV, just pause, take a breath, and ask yourself, hey, have I been wrong before when I've acted on these kinds of feelings? The answer, if we're being honest, is almost always yes. And just remembering that can save you from a huge mistake. All right, this is it. We've arrived at the big one. The single biggest, most common, and most expensive mistake that separates regular investors from the disciplined approach of someone like Warren Buffett. It's that burning desire to time the market. You hear Buffett say this all the time. Success in this game has almost nothing to do with how high your IQ is. Once you're reasonably smart, that's enough. What really matters, what separates the winners from the losers, is temperament. It's all about controlling those powerful gut feelings, fear and greed, that gets so many people into so much trouble. Let's make this real. Think back to the European debt crisis in 2011. The markets were tanking and people were freaking out. Panicked investors, the herd, pulled almost $100 billion out of stock funds. And what was Buffett doing? The exact opposite. He was calmly investing nearly $24 billion into the market. He was buying when literally everyone else was selling in a panic. And this quote just nails his whole philosophy, doesn't it? It's so incredibly simple. A market crash, a crisis, a scary headline. To Buffett, that's just a Black Friday sale. It's a chance to buy wonderful American businesses at a huge discount. He doesn't see pessimism as a risk, he sees it as an opportunity. What you're looking at here is something called the behavior gap, and it's the absolute heart of this whole paradox. It's the difference between how an investment, like an index fund, actually performs versus the return the average investor in that fund actually gets. And what causes that gap? Just one thing: our own behavior. It's the money we leave on the table because we let our emotions drive, selling low in a panic and buying high in a frenzy. So the big question is, how do we fix this? How do we close that gap and stop being our own worst enemy? How can we start acting a little more like Buffett?
Well, the solution is surprisingly simple, and it has nothing to do with having a crystal ball. It's a simple, almost boring mechanical process called rebalancing. All it means is bringing your portfolio back to the percentages you decided on when you were calm and rational. But the magic of it is that it automatically forces you to do the right thing. It hardwires buy low, sell high right into your system. It's basically the antidote to the behavior gap. So here's the game plan, just 4 easy steps. 1. You decide on your mix, say 60% stocks, 40% bonds. 2. You check in on it every so often, maybe once a year. Now, let's say stocks have a killer year, and suddenly they're 70% of your portfolio. That's your trigger for step 3. You sell some of those high-flying stocks to get back down to 60%. And then step 4, you take that cash and buy more of the bonds that have been lagging. See, it systematically forces you to do what Buffett does naturally. Trim what's gotten expensive and buy what's on sale. At the end of the day, following a simple plan like this has absolutely nothing to do with being a genius. It's all about discipline. It's about having the strength to tune out the noise, to ignore your screaming gut feelings, and to just stick to the plan you made for yourself when you were thinking clearly. And that really brings us to the final question, which isn't about the stock market or forecasts at all. It's about you. You've already got the intelligence you need to succeed. The only question left is, can you develop the temperament? Thanks for joining this explainer.
So everyone wants to invest like Warren Buffett, right? But here's the thing a lot of people miss. Just trying to copy his stock picks, well, that's a losing game. The real secret, the thing that actually matters, isn't in what he buys. It's all about how he thinks. And in this explainer, we're going to dive deep into that very mindset and pull apart the psychological principles that really drive his incredible success. You know, it's a really interesting paradox when you think about it. Warren Buffett is incredibly open about his strategies. He writes these long annual letters, he gives interviews. I mean, the information is all out there. And yet, the average investor just consistently fails to get anywhere near his results. So why is that? The answer, it turns out, is something much, much deeper than just financial analysis.
And there it is, straight from the Oracle of Omaha himself. This is the answer to our paradox. It's not about having some genius-level IQ or a super complex algorithm. Nope. It's about having the psychological discipline, the temperament to control your emotions when everyone else around you is completely losing their cool. All right, so here's our game plan. We're going to start with that core mindset paradox. Then we'll get into how to completely rethink good and bad news, how to escape that short-term panic thinking, and how to build a plan you can actually stick to. And finally, we'll pull it all together so you can start putting these principles to work. Okay, let's start by really unpacking this central idea. We tend to think that the smartest people must be the best investors, but we're about to see exactly why that emotional strength, that temperament, is the real key to unlocking success over the long haul.
Look, the goal here is not to give you some secret formula, because, spoiler alert, one doesn't exist. Instead, we're going to focus on 3 really crucial insights into Buffett's thinking process that you can actually start using. It's all about shifting your perspective.
First up, let's tackle one of the biggest traps for any investor, reacting to headlines. We're just wired to see bad news on TV and immediately expect bad results in our portfolio. But in the world of investing, that is a really dangerous oversimplification. This just feels right, doesn't it? The economy's in trouble, a whole industry is in crisis. I mean, surely that means any money you have in that area is doomed. This is a classic gut reaction, but as you're about to see, it is often completely wrong. Let me show you a really powerful example. So, take a look at the commercial real estate crisis around 2010. In 2008, only about 1% of loans were delinquent. A year later, in 2009, that number jumps to 6%. And then by 2010, it hits a peak of 9%. The headlines were getting progressively, undeniably worse. You'd think anyone invested in this space would have been just absolutely crushed. But despite that waterfall of terrible, terrible news, this is what happened to certain junior AAA-rated commercial mortgage bonds. They didn't crash, they soared, going from trading at just 30 cents on the dollar to nearly 100 cents. That's a staggering 233% gain. How on earth is that even possible? And this, right here, is the whole secret. It's all about market surprise. The market had already priced in an absolute catastrophe. Everybody expected things to be apocalyptic. So when the default rate only hit 9%, Well, that's still awful news, right? But it wasn't the complete end-of-the-world scenario the market had already braced for. So the key isn't that the news was good, it's that the bad news was better than expected, and that is a positive surprise.
Okay, this leads us perfectly into our next big concept. The ability to look past the scary headlines and see that potential for surprise is what separates the pros from the amateurs. It's the difference between falling into a psychological trap called stage one thinking and avoiding it like Buffett does.
Stage 1 thinkers see a crisis and they react with their gut. They see the fire and their only instinct is to run for the hills. Panic kicks in and any rational plan they might have had just goes right out the window. Buffett, on the other hand, is a classic Stage 2 thinker. He sees the crisis, sure, but his head stays in control. He's already thinking one step ahead, asking, okay, what happens next? How will governments and central banks respond to this? He sees beyond the immediate flames. And here's the huge problem for Stage 1 thinkers who sell in a panic. They tell themselves they'll just wait on the sidelines until things feel safe again. Think of it like a lifeguard at a beach. You can wait for that red flag to come down and a nice green one to go up. But in the world of investing, yeah, that green flag, it never comes. There is always something to worry about.
And the cost of waiting for that mythical green flag can be absolutely devastating. Just look at this period between 2009 and 2011. The news was filled with red flags. Global financial crisis, high unemployment, fear everywhere. It felt like the worst possible time to invest. And yet, the S&P 500 more than doubled. It was one of the greatest rallies in history. And what were most investors doing? They were pulling hundreds of billions of dollars out of the market, completely missing the recovery because they were waiting for an all-clear signal that never ever arrived. So the next time a crisis hits and you feel that panic churning in your stomach, just stop and ask yourself these questions. This is your checklist to force Stage 2 thinking. Am I just reacting? Is this horrible news already reflected in these low prices? And maybe the most important one of all, if I sell now, how in the world will I ever know when it's safe to get back in? The painful truth is, you won't. There's no signal.
This brings us to the solution. How do you control those emotions and force yourself to think for the long term? Well, you don't rely on willpower alone. You rely on a system. You need an indispensable, predefined plan.
Buffett is an avid bridge player, and he says investing is actually a lot like it. In bridge, you have a system that's based on logic and probabilities. You don't just abandon that system in the middle of a game because you have a funny gut feeling, you trust the process. Investing should be exactly the same. Your decisions have to be based on your rational plan, not on the market's wild and chaotic mood swings. In creating this plan is really a three-step process to build your defense against your own emotions. First, you define your system. That's your target mix of stocks, bonds, whatever. This grounds everything in logic before a crisis even hits. Second, and this is so critical, you have to write it down. This turns a vague idea in your head into a firm commitment on paper. And third, you stick to it with discipline. Your only job is to follow your own rules, not the market's crazy mood. And this really brings us full circle. That written plan, it's not really for your brain. You already know what's in it. The plan is for your stomach. It's the tool that you use to control those primal urges, that fear and greed, that get so many other really smart people into so much trouble. So we've broken down the mindset. We get the importance of temperament, of rethinking the news, avoiding that Stage 1 panic, and having a plan. Okay, now it's time to turn the lens back on yourself. So let's do a quick, honest self-check. No judgment here. As you look at these questions, just think about your own investing behavior. Do you listen to the so-called experts trying to predict the next market move? Do you try to time the market? Have you ever sold in a panic only to watch helplessly as the market recovered without you? And be honest, do you actually have a written plan that you follow with discipline? Now, if you found yourself nodding along to some of those destructive behaviors, don't worry, you've just taken the first and most important step. The source material makes this brilliant point. This whole process is like recovery. There are no cured market timers. There are only investors who are consciously and actively practicing discipline, day in and day out. And this all comes down to maybe Buffett's most famous quote, because it perfectly captures everything we've talked about. The concepts themselves are simple. Buy a diversified portfolio, have a plan, don't panic. But actually doing it, actually executing that plan when your emotions are screaming at you to do the exact opposite, well, that's the part that isn't easy. We've laid out the simple part for you here, the framework for how to think like the best. The real challenge, the not easy part, that begins for you right now. It's about developing the temperament and the discipline to put these ideas into practice, not just when the market is calm, but when the next storm inevitably hits. The only question is, are you ready for it?
When it comes to your money, there's a huge battle going on. It's this fundamental clash between two big investing ideas. And honestly, your entire financial future could depend on picking the right side. So today, we're going to cut through all the noise, dive into the actual evidence, and use some simple math to find out which one really wins.
So let me just ask you this straight up. Are you playing a winner's game with your money or a loser's game? Seriously, think about it. How you answer that one question might be the single biggest factor in whether or not you actually reach your financial goals. So yeah, let's find out. You know, every single person who invests, and that probably includes you, has already, whether they realize it or not, picked a side in this big debate. Your financial future really does hinge on making sure you've chosen the right strategy. So we're about to cut through all the hype and figure out which one that is. Okay, so on one side, you've got active investing. This is the stuff you see everywhere, on TV, in the news. It's this exciting idea that if you're smart enough, if you do enough research, you can outsmart everyone else. Find those hidden gem stocks and perfectly time the market's ups and downs. But then, on the other side, you have passive investing. This philosophy says, hang on, markets are actually pretty darned efficient. The price you see is probably the right price. So trying to beat the market is kind of like a fool's errand. The goal isn't to beat the market, it's to be the market.
So if this decision is so critical, why isn't the right answer just obvious? Well, it's because the very people we look to for advice, Wall Street, the financial media, they have a massive, and I mean massive, vested interest. They make their money from high fees, from trading commissions, and from spinning these exciting stories about the next stock-picking genius. They absolutely need you to believe that the active game can be won. All right, so let's just push all the opinions and the biased advice to the side for a minute and look at the cold, hard evidence. I mean, if active investing really works, we should be able to see it, right? We should see it in the performance of the people who are actually trying to do it. So we're going to look at three key groups: regular individual investors, the pros at mutual funds, and what they call the smart money in pension plans. First up, individual investors, people like you and me. And the academic research here is, well, it's brutal. Study after study shows the same thing. The stocks that individuals pick to buy tend to do worse after they buy them. And get this, the stocks they sell often do better after they're gone. The data couldn't be clearer. The more you trade, the worse you do. And it's usually all fueled by simple overconfidence. And this overconfidence thing, it's a huge problem. One study found that, on average, investors thought they were doing a whopping 11.5% better each year than they actually were. That is a massive gap between perception and reality, and it's what keeps people playing a game that they don't even realize they're losing.
And hey, if you think, well, I just need to be smarter to win, think again. There was an investment club for Mensa members, a group made up entirely of certified geniuses. And they managed to underperform a simple market index by almost 13% per year for 15 years straight. So if a room packed with geniuses can't do it, what chance do the rest of us really have?
Okay, so what about the professionals? The highly paid mutual fund managers with all the fancy degrees? Well, the evidence there is just as damning. There is zero proof that any manager can consistently beat the market beyond what you'd expect from just pure random luck. Instead, things like their high expenses and constant trading costs act like a ball and chain, a guaranteed drag on performance. In fact, you know what the single best predictor of a fund's future performance is? It's not a star manager, it's simply how low its costs are. But hey, don't just take my word for it. Listen to this. It's from Warren Buffett, who is arguably the greatest active investor of all time. He says that a know-nothing investor who just buys and holds a low-cost index fund will end up beating the vast majority of professionals. I mean, coming from him, that's an absolutely incredible statement.
All right, last group, the pension plans. This is the smart money. They have enormous resources, access to the best managers on the planet. Surely they can win this game. But the evidence says no. One study found they consistently hired managers after a hot streak, only to watch that amazing performance just vanish the second they invested. And here's the cruel twist. They would have actually made more money if they had just stuck with the managers they had just fired. The conclusion was stark. Their chance of picking a winning manager was literally no better than a coin flip.
So, the performance evidence is, to put it mildly, overwhelming. But, beyond all that data, there's something even more powerful. It's a simple, kind of elegant mathematical proof that shows why active investing as a whole group well, it cannot win.
What if we could settle this hold the date right now? Not with a bunch of complicated performance charts, but with some undeniable arithmetic. A Nobel Prize winner named William Sharpe did exactly that, and it's a simple proof that every single investor really needs to understand.
The whole thing starts with a really basic idea. The entire stock market is just made up of two groups of people: active investors, who are all trying to beat the market, and passive investors, who are just trying to own the market. That's it. And since every single share of every stock has to be owned by someone, the sum of those two parts has to equal the whole market. Simple enough, right?
Now, this is where that simple math gets really powerful. Before we even think about costs, passive investors, by their very definition, get the market's return. So for the whole equation to balance, that means that active investors, as a group, must also earn the exact same market return. Just think about it for a second. For every active investor who is a genius and overweights a winning stock, there has to be another active investor on the other side of that trade who underweighted it. Their wins and their losses are a perfect zero-sum game. They completely cancel each other out.
And look, this isn't some temporary thing that works sometimes. This arithmetic is like an iron law of investing. It's true for any asset class you can think of: U.S. stocks, international stocks, you name it. It's true in roaring bull markets, and it's true in painful bear markets. Before costs, active investors as a big group simply cannot beat the market because they collectively are the market.
So if both groups earn the exact same return before costs, what decides who wins? Well, this brings us to the hidden opponent that every single active investor is really fighting against, whether they know it or not.
Here it is. This is the deciding factor. We've been ignoring the most important part. We don't get to keep our gross returns. You only get to spend what's left over after all the costs. So since both active and passive investors start at the exact same finish line, the total market return, the group that pays less in costs, is mathematically guaranteed to end up ahead. It's really that simple.
And this is where active investing faces this huge disadvantage. It's not just one cost, it's like a whole obstacle course of them. Active funds have higher expenses. They have way more trading costs because of all that buying and selling. They pay brokerage commissions. They have to deal with something called market impact. And even just holding cash creates a drag on returns. Every single one of these hurdles just chips away at your final results. So this brings us to the one unavoidable conclusion. Since passive investing has dramatically lower costs all across the board, passive investors as a group must, by mathematical certainty, earn higher net returns than active investors as a group. Active management isn't a zero-sum game. It's a negative-sum game. It is a loser's game, period. Okay, so we've seen the evidence, we've seen the math. Active investing is, well, a loser's game. So how do you make sure that you are playing the winner's game? Let's talk about the actual practical strategy.
The winning strategy is just beautifully simple. You refuse to play the loser's game. And the tools to do it are right here. You can easily and super cheaply own the entire market through low-cost index mutual funds or through exchange-traded funds. You probably know them as ETFs. These things are designed to do exactly what we've been talking about. Just capture the market's return with the least amount of friction possible. The goal is to be broadly diversified, trade as little as you possibly can, and, most importantly, keep your costs at rock bottom.
So, there you have it. The evidence is clear, the math is undeniable. You now know the winning strategy for your money. But this leads to the most important question of all, doesn't it? How do you connect that money, that winning strategy, to the life you actually want to live? Because that's the whole point of real financial planning.
Hey, welcome to The Explainer. You know, we're always told to save, to invest, but there's this one crucial first step that, honestly, most of us just skip. And it can be the difference between hitting your financial goals and, well, just wandering around aimlessly. So today, we're going to dig into why having a plan isn't just a good idea. It's literally everything. Think about it like this. Would you ever take a trip to a place you've never been without a roadmap or directions or at least your phone's GPS? No way, right? You wouldn't just get in the car and hope for the best. Well, your financial future, that's the most important journey you'll ever take. So why on earth do so many of us start it completely blind, without any map at all? There's that old saying, those who fail to plan to fail. And look, it might sound like a cliche, but in finance, it is a fundamental truth. Kicking off your investment journey without a clear written plan, it's like setting yourself up to fail right from the get-go. It's a gamble you just don't have to take. Okay, so let's dive into this. Let's really explore this common problem. Why do so many of us just jump straight into investing without even thinking about charting a course first? And this slide just says it all, doesn't it? The vast majority of investors start out with no plan. We hear about some hot stock, or we see a cryptocurrency going to the moon, and that fear of missing out, it kicks in hard. So the crowd just rushes toward that promise of a quick buck, totally skipping the most important step, the plan. Just understanding that impulse is the first step toward getting it under control. And this slide reveals something really important, a kind of conflict of interest you need to be aware of. See, when you invest without a plan, when you're driven by all that market noise and your own emotions, you're probably going to trade a lot more. And all that chaos, well, it's really profitable for an industry that makes money on fees and transactions. A disciplined investor, someone with a written plan, you're basically their worst customer. Your plan is your best defense. Okay, so if investing without a plan is the big problem, what's the solution? Well, it's about creating a formal written document. Think of it as a contract you make with your future self. And this is the key term you gotta know, the Investment Policy Statement, or IPS for short. This is your personal roadmap. It's the document that spells out exactly where you wanna go, financially speaking, and the precise route you're gonna take to get there. It's the GPS for your whole journey. And that is such a powerful way to think about it. An IPS isn't just some piece of paper collecting dust. It's a real commitment. When the markets get choppy and your emotions are running high, and trust me, they will, this contract is what you fall back on. It forces you to stick to the rational, smart decisions you made when you were calm and thinking clearly. But here's the thing. This contract isn't written in stone. It absolutely has to be a living document. I mean, your life isn't static, right? So your financial plan can't be either. It needs to be flexible enough to adapt to whatever life throws at you, but without being totally abandoned at the first sign of trouble. So what does it mean for a plan to be living? This slide lays it out perfectly. Yeah, you should check in on it annually, for sure. But beyond that, you've got to revisit your plan after any major life event. A new baby, a new job, a marriage, an inheritance, whatever it is, these are the moments when you have to pull out the map, check your location, and maybe, just maybe, adjust your course. The plan has to evolve with your life.
So, where do you even begin? Before you can write a single word of this plan, you have to do a really deep, honest self-assessment. Any good plan has to be built on a foundation of your unique personal circumstances.
These are the absolute fundamentals. How secure is your job? Think about it. If you work in the tech industry, should you be way over-invested in tech stocks? Probably not a great idea, right? How long do you have until you want to retire? And this is a big one. How much volatility can you actually handle emotionally without totally freaking out and selling everything? You have to be brutally honest with yourself about these things. This image here really boils the whole process down. It all comes down to answering these 5 big questions. How much can you realistically save? How much risk are you truly willing to take on? How much money will you actually need? When will you need it by? And finally, what do you want to leave behind? Answering these helps you strike that perfect balance between who you are today and who you want to be in the future.
Now this is a critical distinction that trips up so many successful people. The aggressive, super concentrated risks you might have taken to build your wealth, they are often the exact opposite of the strategies you need to preserve it. It's like once you've won the game, you have to completely change how you play to make sure you stay in it.
All right, so your investment policy statement is absolutely vital, but it's still just one piece of a much, much larger puzzle. Let's zoom out for a second and look at the whole picture. A truly comprehensive financial plan has to bring all of these things together. Your investment strategy has to work hand in hand with your tax planning, your insurance coverage, your goals for your estate. They are all interconnected pieces of your financial life. You can't just look at one in isolation. And for anyone who's thinking about their legacy, this is a really powerful idea, a family wealth mission statement. It goes way beyond the numbers on a spreadsheet. It forces you to ask, what is all this wealth actually for? It helps you spell out the values and the principles you hope to pass on, making sure your legacy is about so much more than just money. All right, let's get practical. We've talked about the why and the what, so now let's talk about the how. How to actually put all of this down on paper and prepare for the challenges that are, inevitably gonna come up. Let's ask the scary question. What if a major bear market hits your portfolio? And look, this isn't a matter of if, it's a matter of when. Every single investor will face a severe downturn at some point. The difference between success and failure is having a predefined contingency plan before the crisis hits so you don't make panic decisions in the heat of the moment. Your written plan should actually list out these levers you can pull in the order you'd prefer to pull them. Knowing your options ahead of time, it transforms that feeling of fear into a simple checklist. So instead of panicking when the market drops 20%, you can calmly open your plan and say, okay, time for step 1. We're going to reduce our spending. It puts you right back in the driver's seat. Look, vague goals just don't work. I want to save more isn't a plan. Your IPS needs hard numbers. How much are you going to save each year? What's the total asset number you're aiming for, and by what date? When do you plan to start taking money out, and how much will you take out each year? These specific, measurable targets are the only way to track your progress accurately. You can't know if you're on track unless you've defined exactly what on track means. And finally, we get to the very heart of your IPS, your target asset allocation. Now that sounds complicated, but it just means deciding how you'll divide your money between different types of investments, like stocks and bonds. But here's the real magic, the rebalancing bands. Let's say stocks do really well and they grow from your target of 30% all the way up to 36% of your portfolio. Your plan automatically forces you to sell that extra 1% and put it into bonds. This is the secret sauce. It's the mechanism that provides the discipline to automatically sell high and buy low, and it takes your emotions completely out of the equation. So we end up right back where we started. Investing without a plan, it's really just financial wandering. A well-crafted investment policy statement as part of a bigger, comprehensive financial plan is the map. It's the thing that gives you the best possible chance of reaching your destination safely and on time. So the only question left is, have you drawn yours?
All right, welcome. Today, we're going to tackle one of the biggest, most personal questions in all of finance. How much risk should you be taking with your investments? Seriously, it's a decision that's going to pretty much define your entire financial future. So yeah, let's dive right in.
So let me ask you a question. What do you think is the single most important decision you'll ever make as an investor? Is it about picking the next Apple or Tesla? Is it about trying to perfectly time the market? Well, the answer might actually surprise you.
You know, study after study after study shows that the number one thing that drives your long-term results isn't which specific stocks you picked, it's your asset allocation. And that's just a fancy way of saying it's the big picture decision of how much you put into risky stuff, like stocks, versus safer stuff, like bonds. That one decision is pretty much the whole ballgame.
So here's our game plan for today. We're going to start by figuring out your personal risk profile. That's all about your ability, your willingness, and your need to take risks. Then we'll get practical and talk about actually building your portfolio. We'll uncover the magic of diversification, the only free lunch in investing, and finally, we'll wrap up with how to invest smarter, not harder.
Okay, first things first, let's build your personal risk profile. And look, this isn't about finding some secret one-size-fits-all formula. It's about really understanding yourself. The perfect plan for you is built on these 3 key pillars: your ability to take risk, your willingness to do it, and your actual need for it. Let's kick things off with your ability to take risk. This is the most objective part of the whole thing, the black and white part. It really boils down to 2 things: how much time you have and how stable your job is. And this chart here, it does a great job of connecting time to risk. Your investment horizon is just how long you have until you need to use the money. So think about it. If you're investing for retirement, and that's more than 20 years away, you've got tons of time to ride out any market crashes. You can afford to be 100% in stocks. But what if you need that money in, say, 3 years for a down payment on a house? Well, your ability to take risk drops to pretty much 0.
But time isn't the only thing. There's this other huge asset that most people totally forget about, because it never shows up on any brokerage statement. It's called your labor capital. Just think of it as the total value of every paycheck you're going to earn for the rest of your life. When you're just starting out, this is, without a doubt, your biggest asset.
Okay, so how should you actually think about this? Well, what really matters is how stable it is. For example, if you're a tenured professor, your income is super stable, right? That's basically like owning a bond. But if you're a salesperson working on 100% commission, your income is going to be all over the place. That's a lot more like a stock. So if your job is already risky like a stock, you probably want more stable bonds in your portfolio to balance things out. And whatever you do, please do not load up on your own company's stock. That is a terrible idea. If things go south, you could lose your job and your life savings all at once. It's a risk you just don't need to take. Okay, so that's your ability to take risk. But now we're going to move into the squishier, more psychological side of things. Your willingness, your need, and yeah, your guts. This is all about whether you can really handle the heat when things get tough in the market.
All right, this right here is what I call the stomach acid test. It is so easy to call yourself a long-term investor when everything's going up and to the right. But what happens when you wake up and your portfolio is down 20, 30, even 40%? Your true willingness to take risk is all about whether you can stick to your plan in those moments or if you're going to hit the panic button and sell everything at the absolute worst time.
And this little chart is a fantastic way to actually put a number on that gut feeling. So I want you to be really honest with yourself. What is the absolute biggest drop you could see in your portfolio without totally freaking out and making a bad decision? If that number is, say, 20%, then this guide suggests your stock exposure shouldn't be much more than 50%. It's a really simple but powerful way to match your portfolio to your personality.
And the last piece of this puzzle is your need to take risk. This comes down to your goals. Are we talking about funding a basic, comfortable retirement? That's a need. Are we talking about buying a fancy vacation home? That's probably more of a desire. The more needs you have that require a really high return, the more risk you might feel forced to take. But if you're honest about what's a must-have versus a nice-to-have, you can often build a portfolio that's a whole lot less risky.
Okay, so we've done the soul searching, we've figured out our personal risk profile. Now for the fun part. Let's translate all that theory into an actual real-world portfolio of stocks, bonds, and other stuff. Now, before we jump into the exciting stuff like stocks, we have to get the role of bonds right. Their job is not to shoot the lights out with amazing returns. Their one and only job is to be the shock absorber for your portfolio. They are your defense. And because safety is their whole purpose, you want to stick with the safest kinds out there. Things like U.S. government bonds, super high-quality municipal bonds, or FDIC-insured CDs. You want boring. Boring is good here.
So what about all that other stuff you hear about? Alternative investments? Well, here's the good news. For most of us, you can pretty much ignore all the complicated, high-fee stuff, like hedge funds or private equity. But the research does show there are two that might be worth considering, mainly because they behave differently than stocks and bonds. The first is real estate, which you can own super easily through something called a REIT. The second is commodities, like gold or oil. Adding a small slice of these can help smooth out the ride.
And this all leads us to maybe the single most powerful concept in investing. It's so powerful, it's been called the only free lunch. And that's the beautiful idea of diversification.
Let's travel back in time for a second to see this in action. The year is 1998. The dot-com boom is roaring. The S&P 500 is up a whopping 29%. But if you happen to own a different type of stock, small cap value stocks, you were miserable. You were down 10%. You would have felt like a total idiot.
But then, just a few years later in 2001, the tables completely turned. The tech bubble had popped, and the S&P 500 was down 12%. And those boring old small-cap value stocks, they were up an incredible 40%. Now, if you had just owned both of them, you would have had a much, much smoother and less stressful ride. That's diversification in a nutshell. And this simple little graph shows you exactly why that works. You can take two different volatile assets, let's call them X and Y, that don't always move up and down at the same time. When you combine them into one portfolio, which is Z, you end up with something that is way less volatile than either one on its own. You're cutting your risk without giving up your expected return. That, my friends, is the free lunch. It's just that simple. I love this quote. Since diversification is the only free lunch in investing, you might as well eat a lot of it. So what does that mean in practice? It means owning different-sized companies, owning both value and growth stocks, and owning companies from all over the world, the US, other developed countries, and emerging markets.
All right, we are in the home stretch. We've got our strategy. Now we just need to cover a few key details to make sure we're putting it all together in the smartest way possible. This is about where you put your assets, what you use to invest, and which risks to avoid at all costs.
This next idea, asset location, sounds complicated, but it's really just about putting your investments in the right type of account to save on taxes. The rules are pretty straightforward. Rule 1, always, always, always fill up your tax-advantaged accounts like your 401k or IRA first. Then, the general rule of thumb is to put your least tax-friendly investments like bonds that pay interest every year inside those tax-sheltered accounts. That leaves your more tax-efficient investments like stocks to be held in your regular taxable brokerage account.
And finally, let's get really clear about the difference between good risk and bad risk. Good risk is the overall risk of the entire stock market. It's the risk you get paid to take over the long run. Bad risk is the risk that one single company might go bankrupt. The market gives you absolutely no extra reward for taking that risk because it's so easy to get rid of through diversification. Putting all your money on one company's stock, that's not investing, that's speculating. It's a gamble. Owning a low-cost index fund with thousands of stocks, now that's investing.
So there you have it. We've walked through the whole framework, your ability, your willingness, and your need to take on risk, and then how to translate that into a smart, diversified portfolio. The goal here isn't to chase the absolute highest returns. The goal is to build a portfolio that actually fits you, that lets you reach your goals, and most importantly, lets you sleep at night. You have the framework now. So, are you ready?
All right, let's dive into one of the most important topics for any investor, how to actually build a well-designed portfolio. We're going to go on a journey using 37 years of real data to construct a portfolio step by step. You'll see exactly how a few smart, deliberate choices can turn a basic portfolio into something much more powerful. But before we start building, let me ask you something. Take a hard look at your own investments. Are they truly diversified? Or have you, over the years, just kind of been collecting funds? It's an honest question, and believe me, the distinction is absolutely everything. It's the core problem we're going to solve right now.
So here's our game plan. First, we'll tackle the diversification dilemma, where so many people go wrong. Then we'll build a simple baseline portfolio to get us started. From there, we'll start adding layers of real diversification. We'll look at the risk-return trade-off, and then, this is the fun part, we're going to flip the whole script on risk. Finally, we'll wrap up by talking about how to play the winner's game.
Okay, let's kick things off with the big dilemma. You've probably heard that diversification is the only free lunch in investing. It's this incredible opportunity to potentially improve your returns without taking on a proportional amount of risk. And yet, most investors just don't take full advantage of it. They get stuck in an illusion of safety.
And you see these mistakes all the time. An investor might think, hey, I own 10 different mutual funds, I'm super diversified. But then you look closer, and they're all US large company stock funds. What you've accidentally created is something called a closet index fund. You've basically just rebuilt the S&P 500, but you're paying way higher fees to do it. So this is the key takeaway, the secret sauce right here. Real diversification isn't about how many funds you own. It's about owning different asset classes. Think of an asset class like a food group for your portfolio. You have your US stocks, your international stocks, your bonds, your real estate. The magic is that these different groups don't all move up and down at the same time. Spreading your money across them is what gives you that smoother ride. Okay, enough theory. Let's see how this actually works in the real world. We're going to build a portfolio piece by piece, and we're going to backtest it using data from a 37-year stretch, all the way from 1975 to 2011. Our starting point is going to be a super common, very conventional 60% stock, 40% bond portfolio.
Now, before we get to the numbers, we need to know one term: standard deviation. Don't let the fancy name scare you. It's just a way to measure volatility. The risk. Think of it as the bumpiness score for your investments. A higher number means a wilder, bumpier ride. A lower number, that's a smoother, more predictable journey. We're going to be keeping a close eye on this number.
And here it is, portfolio number 1. This is our baseline, our control group. It's about as simple as it gets. 60% of the money is in an S&P 500 index, which covers large U.S. companies. The other 40% is in simple 5-year U.S. Treasury notes. A ton of people start with a portfolio that looks a lot like this. So, how did it do?
Well, over those 37 years, this simple mix gave us an annualized return of 10.6%, and its standard deviation or risk score was 10.8%. Now, I want you to burn these two numbers into your brain, because our entire goal from here on out is to see if we can do better. Okay, let the games begin. We're going to start evolving this portfolio. The key thing to remember is we're going to keep the overall 60-40 stock-to-bond split, but we're going to start slicing and dicing that 60% stock portion, adding new asset classes to see what happens.
For our very first move, we're not even leaving the country. We're just diversifying within the U.S. market. We're taking that 60% stock allocation, cutting the S&P 500 part down to 30%, and putting the other 30% into U.S. small-cap stocks. So now, we've got exposure to both the big guys and the little guys in the American economy.
And boom, look at that, an immediate impact. Our annualized return just jumped from 10.6% all the way up to 11.7%. That is a huge boost. So what happened to the risk? Well, the standard deviation barely moved. It only ticked up from 10.8% to 11.4%. So a lot more return for just a tiny bit more risk. That is a trade you take all day long.
All right, next step. We're getting even more granular. We're going to split up our U.S. holdings again, but this time we're adding a tilt towards what are called value stocks. You can think of these as companies that might be on sale. The market might be undervaluing them a bit. So we're adding both large and small value stocks into our mix.
And as you can see, the trend continues. Our return keeps climbing, now up to 12.2%. But, and this is a big but, you have to notice that the risk is climbing right alongside it. It's now up to 12.5%. So far, this is a pretty classic risk-reward trade-off. To get more, we've had to risk more. This sets the stage for our next move, which is the most important one. All right, now for the game changer. We are officially breaking out of the U.S. market. We're taking half of our total stock money, that's 30% of the entire portfolio, and we're moving it into international stocks, specifically international value and international small-cap stocks. This is a massive leap in diversification.
And this right here is why we do this. This is fantastic. Just look at these numbers. The return went up again to 12.4%. But check out the risk. The standard deviation dropped. It went from 12.5% down to 11.8%. Did you catch that? We got a higher return for less risk. That is the free lunch everyone talks about. That's the magic of global diversification.
Okay, let's just pause for a second and soak that in, because that was a huge moment. We literally just saw the free lunch in action. By adding asset classes that don't move in perfect lockstep with each other, we completely changed the relationship between risk and return for the better. Let's put some hard numbers on it. If you compare where we are now with Portfolio 4 to where we started with Portfolio 1, our returns have increased by a relative 17%. But the risk? It's only gone up by about 8%. So our returns grew more than twice as fast as our risk did. That is the definition of a more efficient portfolio.
Okay, let's try one more thing. Let's add in a small slice of commodities. Now, most people think commodities are super risky, right? And if we look at the numbers, yeah, our overall return does dip just a little bit. But here's the kicker. The portfolio's risk, its standard deviation, drops by nearly twice as much. So once again, adding a so-called risky asset actually made the entire portfolio safer.
So, up to this point, we've been using diversification to chase higher returns more efficiently. But what if that's not your only goal? What if there's another way to play this game? Now we're going to take everything we've learned and flip the script completely.
You see, you can think of diversification as having two different superpowers. Goal number one is what we've been doing, trying to crank up returns without cranking up the risk too much. But now we're going to try for goal number two, to use our awesome new mix of assets to get a similar return to what we started with, but with way, way less risk.
And here it is, portfolio number 6. We are using the exact same ingredients from our most diversified portfolio. All the U.S. stocks, the international stocks, the value stocks, the commodities, all of it. But we're changing the recipe. We're shifting the mix to be more conservative. Only 40% in stocks and 60% in bonds.
And this, my friends, is the big reveal. This is the aha moment of this whole explanation. I want you to look at this table and just compare the top line, our simple starting point, Portfolio 1, with the bottom line, our new, super diversified but more conservative Portfolio 6. The numbers are just, well, they're pretty incredible.
This is it, the whole point of our journey, right here on one chart. Look at that. Portfolio 6, our diversified, more conservative model, delivered a higher return than our simple starting portfolio, but it did it with 27% less risk. I mean, think about that. A better result with a much, much smoother ride. This shows that how you design your portfolio matters. It's not just theory, it's a smarter way to invest. Now, building a portfolio like this is half the battle. The other half is having the discipline to stick with it. So the real question isn't just what's in your portfolio, it's whether you have the conviction to let it do its job for you over the long run. All right, let's get into it. You know, we spend so much time and energy carefully building an investment portfolio, but what about keeping it in shape? So today, we're going to talk about the crucial, ongoing work of portfolio maintenance, the stuff that happens after you've set it all up to make sure your strategy actually works for the long haul.
So here's what we've got on tap. First, we're going to think of your portfolio as a garden. It's a great analogy. Then we'll get into the art of rebalancing, see what it looks like in the real world, and then pivot to some really smart tax management strategies. And finally, we'll tie this all back to the main point, right? Reaching your financial goals.
And this quote right here, this is really our guiding star for today. An investment portfolio is not a set it and forget it kind of deal. It's much more like a living, breathing thing, like a garden. It needs consistent care to really thrive, and, just as importantly, to keep it from getting completely wild and overgrown.
So what exactly happens when you don't tend to that garden? Well, you get a sneaky little problem called style drift. It means that the careful balance you designed at the beginning starts to shift, often so slowly you don't even notice. And then one day you look up and your portfolio is something else entirely. Okay, so let's say this is your game plan. You decide on a classic 60-40 split. 60% in stocks to get that growth, and 40% in bonds to keep things stable. This is your target, your blueprint for the garden. It's designed specifically for you, for your comfort with risk and what you're trying to achieve.
But then, the market happens. Stocks have a fantastic run, and before you know it, you look at your portfolio and, whoa, it's now 70% stocks and only 30% bonds. That stock portion of your garden has absolutely taken over. Without you doing a single thing, your portfolio is now way riskier than you ever intended it to be. That right there is style drift.
So how do we fix this? What's the tool we use to get things back in order? Well, it's called rebalancing. And this is the active, hands-on process of tending your portfolio. It's the pruning, the trimming, the weeding you do to restore that original beautiful balance you planned for.
You know, what I love about this is how simple it sounds, but how powerful it is. Rebalancing basically forces you to do the one thing every investor says they want to do: systematically sell high and buy low. You're literally trimming your winners, the assets that have grown like crazy, and using those profits to buy more of the assets that have been lagging. It feels so weird to sell the things that are doing well. I get it, but it is an incredibly powerful discipline.
And get this, that discipline actually pays you back over time. It can generate something that finance folks call a diversification return, or my favorite, the rebalancing bonus. Now this is wild. It means the total return of your whole portfolio can actually be higher than just the average of all its parts. How's that possible? Well, it's because you are consistently trimming things when they're a little too high and buying things when they're a little too low, over and over, creating this small but steady advantage.
Okay, so that all sounds great, but how do you know when to do it? You can't be in there every day trimming and trading. That'd be crazy. But you can't just let it go either. So a really fantastic, elegant rule of thumb is what's called the 5-25% rule. Let's break down exactly how this works. Let's start with a smaller piece of your portfolio, something you've targeted for 10%. The rule has two parts. The first is the absolute rule. Has it moved by 5%? That's simple. It gives you a band of 5% to 15%. The second is the relative rule, which is 25% of your target. So 25% of our 10% target is just 2.5%. That creates a much tighter band, 7.5% to 12.5%. The rule says you follow whichever is less or stricter. And since 2.5% is less than 5%, the relative rule wins. You'd rebalance if this thing hits 7.5% or 12.5%.
Okay, now let's apply the same logic to a huge chunk of your portfolio, like a 50% allocation to U.S. stocks. The absolute 5% rule gives us a simple rebalancing band of 45% to 55%. But now look at the relative rule. 25% of that 50% target is 12.5%. That would give you this massive range of 37.5% all the way up to 62.5%. See the difference? So again, we take the one that's less, the stricter rule. In this case, the absolute 5% is the tighter constraint, so it becomes our governing rule. It's so clever how this adapts to keep your big holdings in check without making you overtrade your smaller ones.
So that's the rule. That's the theory. But what does this actually look like in practice? How do you put a system like this into action? Well, it all starts by writing it down, by making it official in your investment policy statement. And this right here is what that looks like. It's a snapshot from a real investment policy statement.
Now, don't worry about reading every single number. The big idea is to see that every single asset class has a target, but it also has a minimum and a maximum percentage allowed. If you look at total U.S. stocks, the target is 50%, but the plan says it's okay for it to drift between 45% and 55%. If it goes outside that band, action is required. This is the 5-25 rule we just talked about, but now it's written down as a clear, actionable plan.
And here's a super important point. You don't just check individual funds. You've got to apply this test at 3 different levels. First, you zoom all the way out. Are my total stocks versus my total bonds in balance? Then you zoom in a level. How about my US stocks versus my international stocks? And finally, you zoom in to the individual asset classes, like emerging markets. Because a drift in just one of these little areas can throw the whole garden out of whack.
Okay, so when it's finally time to act, how do you actually do it? Well, there's a pecking order. The absolute best, most tax-friendly way is to use new cash, money from your paycheck or from dividends, to buy more of whatever's underweight. That way you're bringing things back into balance without having to sell anything and create a tax bill. If that's not enough, then you move to step 2, selling your winners to buy your losers. And if you're retired and taking money out, you can just rebalance naturally by selling from whichever part of the garden has grown the most.
All right, we've tended the garden, it's looking balanced and healthy. But we're not done. Now we have to protect the harvest. Rebalancing is one half of the coin. The other critical piece is proactive tax management. You have to make sure you don't give a big chunk of your hard-earned returns back to the government for no good reason.
One of the most powerful tools in your toolkit here is something called tax loss harvesting. Think of it like strategic weeding. Throughout the year, you look for chances to sell investments that are down for a loss. Now, you're not giving up on them. It's a tactical move. Selling at a loss generates a tax deduction that can be used to cancel out the taxes you owe on your gains. The trick is, you have to immediately reinvest that money into a similar fund to make sure you don't miss the rebound. But there's one big catch you have to watch out for.
And that big catch is called the wash sale rule. The IRS is pretty clear on this. If you sell something for a loss to get that tax break, you can't just turn around and buy a substantially identical security right away. And that means within 30 days before or after the sale. If you do, they say nope, and you lose the tax deduction. So you can't sell an S&P 500 index fund and immediately buy that exact same S&P 500 index fund. It's a critical detail.
So what about when you actually have to sell something that's made a profit? Well, you can be really smart about that too. First, if you've bought shares over time at different prices, always sell the shares you paid the most for first. We call that selling your highest cost basis lots, and it just means your taxable gain will be as small as possible. Second, and this is huge, check the calendar. If you can just hold on to an investment for more than 1 year, that profit becomes a long-term capital gain, which gets taxed at a much, much lower rate than a short-term gain.
Timing your trades can make a big difference too. Here's a classic rookie mistake. Buying a mutual fund in, say, late November, right before it pays out its big year-end distribution. If you do that, you're basically just buying yourself an immediate tax bill, because that payout is taxable income to you. You can even get clever and sell a fund before a big distribution, so you can take your profit as a more tax-friendly capital gain instead.
So we have gone through a lot of the nitty-gritty details of rebalancing and tax management. But let's zoom all the way out for a second. Why does all this meticulous, sometimes tedious work even matter? Let's connect it back to the big picture.
This diagram just says it all, doesn't it? On one side, you've got the science of investing. That's all the disciplined rebalancing and smart tax stuff we've been talking about. And on the other side, you've got true wealth management, which is all about your life, your goals, what you want your money to do for you. Your greatest chance of actually getting what you want is right there in the middle, where that technical skill meets your personal goals.
And that really brings us to the final thought I want to leave you with. When you do this work, when you tend to your portfolio, when you protect your harvest, you make a really fundamental shift. You're no longer just a passenger along for the ride. So the question is, are you actively managing your wealth, or are you just letting it manage itself? Because the difference between those two is everything. Okay, let's talk about a decision that can literally make or break your retirement. Should you manage your own money, or should you hire a professional? You know, the difference between getting this right and getting it wrong can be hundreds of thousands, sometimes even millions of dollars. So yeah, the stakes are incredibly high. Let's dive right in.
So, here's our game plan. First, we're going to look at the real challenges of do-it-yourself investing.
Then, we've got a 5-question test for you to see if you really have what it takes. If not, don't sweat it. We'll then cover the 3 non-negotiable rules for hiring an advisor, what a truly great one actually does for you, and we'll wrap up with a practical checklist so you can find that perfect fit.
All right, let's kick things off with Section 1, the DIY challenge. You know, a lot of us, we think, hey, I can handle my own investments. How hard can it be? But let's get real about what that truly involves.
I mean, this is the fundamental question, isn't it? On one hand, you've got the satisfaction, the control of doing it yourself. But on the other, you have the deep expertise of a professional. It's a real balancing act, and as you can see, the stakes are massive. Getting this wrong isn't just a small whoopsie.
I absolutely love this comparison. Look, if you mess up fixing a leaky faucet, you just call a plumber. It's an annoyance, but it's no big deal. But a major financial error, that's a totally different kind of leak. We're not talking about a puddle on the floor. We're talking about your future security, your retirement, just draining away. And sometimes you just can't get that back.
Okay, so how do you know if you're truly ready to fly solo on this? This next section is a simple 5-question test. Now, nobody's grading you here, but I want you to be brutally honest with yourself. Your retirement could literally depend on it. First question. Do you really have the comprehensive knowledge you need? And pay attention to that word, comprehensive. This isn't just about picking a few hot stocks. It's about understanding how that one choice ripples through your entire life. Your estate plan, your tax strategy, your insurance. It's a huge interconnected puzzle. Question 2. How are your math skills? And I'm not talking about just balancing a checkbook. We're talking about the kind of advanced math that actually underpins modern finance. It's way more complex than most people think. What this really means is getting comfortable with things like probability theory, with statistics. You need to be able to understand the shape of potential returns, these weird-sounding but absolutely critical concepts like skewness and kurtosis. Trust me, these aren't just academic terms. They're the tools professionals use to spot risks that the average person completely misses.
All right, question 3 is a big one. Can you design that perfect mix of stocks, bonds, and other assets that's just right for your specific goals? And then, even more important, can you rigorously test if that plan can actually survive a financial storm? This is really where the pros earn their money. You know, a key part of that testing process involves tools like a Monte Carlo simulator. This is a seriously complex program that runs thousands, even millions of different market scenarios to stress test your financial plan and figure out the probability of success. It's just not something you can whip up on a simple spreadsheet. Okay, on to question 4. Are you a student of financial history? Because you know the old saying, those who don't know history are doomed to repeat its mistakes. Knowing just how brutal and how long bear markets can really be is absolutely essential for setting realistic expectations and, well, not panicking when things get ugly. And this leads us to the last and maybe the most critical question of all. Do you have the right temperament? I mean, it's easy to be a genius investor in a bull market, but what happens when your portfolio is down 30% and every news channel is screaming recession? Will you have the discipline to stick to your plan? Or will that primal fear take over and make you hit the sell button at the absolute worst possible moment? This universal human flaw is so common it actually has a name. It's called the behavior gap. It's that tragic space between how an investment actually performs over time and how the average person invested in it performs. And the reason for that gap? It's simple. We buy high when we're greedy and we sell low when we're terrified. Our emotions are the enemy of our returns.
So, if you went through that little test and realized, maybe I could use some help, you are definitely not alone. So if you do decide to hire a pro, here are the 3 non-negotiable absolute rules you must follow. These are the big 3. I want you to think of them like a 3-legged stool. If even one is missing, the whole thing just collapses. They must be a fiduciary, their advice must be based on evidence, and they must build you an integrated plan. So let's dig into what each one of those really means. This is probably the single most important distinction you need to wrap your head around. A fiduciary is legally and ethically required to act in your best interest. Period. End of story. The alternative is something called the suitability standard, which basically just means a salesperson can sell you a product as long as it's suitable for you, even if there's a better, cheaper option out there. Don't you dare settle for suitable. Demand what's best. The second rule is all about evidence-based advice, and this quote just puts it perfectly.
mean, imagine your doctor prescribed your treatment based on an article in a popular magazine instead of a peer-reviewed medical journal. Would you trust them? Of course not. So why on earth would you trust a financial advisor whose strategy comes from some talking head on TV instead of decades of academic research?
So let's say you find someone who checks all these boxes. What are you actually paying for? It's a totally fair question, and the answer is a whole lot more than just picking stocks and bonds. This is where you see the huge difference between a simple investment manager and a true wealth advisor. Of course, they handle the big life stuff, retirement withdrawal strategies, college funding, gifting strategies, home purchases. But look at these last 2 points, because they are massive. A great advisor acts as an insurance policy. If something happens to you, they're there to make sure your family is taken care of. And they help prepare your heirs to receive that wealth, which can prevent so much future heartache and conflict. That's value you just can't put on a spreadsheet.
Okay, let's bring this all home. We've talked about the why, now let's get to the how. Here is a final checklist you can literally take with you to interview and vet any potential advisor before you even think about signing on the dotted line.
Here's your playbook. First, check credentials like the CFP or PFS. Ask to see their Form ADV. That's basically their official report card with the government. Crucially, insist on fee-only compensation. This gets rid of the conflict of interest that comes from sales commissions. And here are a couple of great interview questions. Ask them how they invest their own money. If they're not eating their own cooking, that is a major red flag. And finally, ask them what an average day looks like. The answer you want to hear is all about solving client problems and doing research, not making sales calls.
You know, this Venn diagram right here, this is the secret to successful investing. On one side, you have things that matter, like what the market returns, but you can't control them. On the other, you have things you can control, like how much you save or what fees you pay. A great advisor's entire job is to keep you focused, like a laser, on that tiny, powerful intersection where what matters and what you can control overlap. Everything else is just noise.
As we wrap things up, I really want to leave you with this powerful quote. The conversation shouldn't just be about cost, it needs to be about value. Because while good advice does have a price, bad advice, even if it seems cheap or even free, will almost always end up costing you a fortune in the long run.
When you think about it, building a financial plan is like building the house you have to live in for the rest of your life. It is one of the most important structures you will ever create. So the final question is really for you. Who do you trust to be your architect?
Today, we're going to explore a really powerful story about how to win the most important game there is, the game of life. It's all built around a simple metaphor, but it reveals a profound lesson about priorities, focus, and, well, what actually matters. All right, let's dive right in. Our story starts with a time management expert talking to a class of ambitious MBA students. And what she does is this really simple hands-on demonstration with a lesson that, trust me, is going to stick with you. So picture this. Instead of a slide deck, she just places this huge, empty glass jar on the table in front of her. Then she starts taking these big, fist-sized rocks and carefully placing them inside, one by one, until she literally can't fit another one in. She looks out at this room of super smart students and asks a pretty simple question. And, they see a jar that's packed to the brim with rocks, so they all confidently shout back in unison, "Yes!" It seems like a pretty obvious answer, right? But oh, she's just getting started. She reaches under the table, grabs a bucket of gravel, and starts pouring it into the jar. With a little bit of a shake, all those tiny pebbles trickle down and fill up all the little gaps between the big rocks. So she asks them again, is the jar full now? This time, there's a little bit of a pause. You can almost feel the gears turning in the room as the students start to catch on to what's happening. One student, figuring it's a bit of a trick, cautiously answers, "No." Exactly. The expert then pulls out another bucket, this one filled with sand, and starts pouring it in. The superfine grains of sand just work their way into all the even tinier spaces the gravel couldn't get to, settling in everywhere. She pours and pours until no more sand will fit. She poses the question one last time. By now, the lesson is really starting to click. The whole class gets the pattern, and this time when she asks, they all shout back together, "No!" And for the grand finale, she grabs a pitcher of water and pours that in too. The water seeps into every last microscopic space, filling the jar right up to the very top. Now, Finally, the jar is completely, totally full. The demonstration is over. But that was just the setup. Now comes the real lesson. The expert turns to the class and asks them, "So, what's the moral of the story?" An enthusiastic student immediately shoots his hand up. And coming from a busy MBA student, his answer makes total sense. He sees it as a lesson in pure productivity. You can always cram one more thing into your day. But that's not the point at all. The expert explains that the real lesson isn't about filling your schedule. It's about prioritizing it. Just think about it. If she had started with the sand or the water, would there have been any room for those big rocks? No way. You'd never get them in. So what are these big rocks? Well, they're your non-negotiables, the truly important things that give your life meaning and purpose. For everyone, they're a little different, but we're talking about things like your family, your health, your dreams, your personal growth. And the sand and gravel? That's all the other stuff, the little things that fill up our days. Okay, so what does the story about a jar of rocks have to do with finance and investing? Well, as it turns out, this metaphor applies perfectly to how we choose to spend our single most valuable asset, our time. The difference is just crystal clear. The active investor, they're obsessed with the gravel and sand. They spend all their time watching financial news, studying charts, trying to beat the market. But the passive investor, on the other hand, focuses on the big rocks. They put a solid, sound strategy in place, and then they get back to living their life. I absolutely love this simple sketch because it captures the idea perfectly. A good investment strategy shouldn't be a source of constant excitement and stress. It should be methodical, disciplined, and maybe a little bit boring, because that boredom is what actually buys you the freedom to go have a full and interesting life. Look, this isn't just some nice theory. Let's see how this plays out in the real world with two completely different stories about two very different investors who both learned the exact same powerful lesson. Our first story is about a young doctor right in the middle of the dot-com craze. He's got a family, a young child, a demanding career, and he's seeing his friends make what looks like easy money day trading. You can imagine how tempting that was. He just had to get in on the action. And his journey started with what felt like a huge win. After long, exhausting shifts at the hospital, he'd come home and spend all night glued to his computer screen, chasing the market. He actually turned a small investment into $100,000. But that financial gain came at an unbelievable personal cost. He was completely consumed. And this is the true price he paid. He became so focused on the sand and gravel, that daily market chase, that he totally lost sight of his big rocks, his family. In a weird way, the best thing that happened was that the bubble burst and he lost all his profits, because that was the wake-up call he desperately needed to reevaluate everything. Now, you might hear that story and just think, well, that was a novice getting in over his head. But our next story is about Rick Hill. And Rick was the complete opposite of a novice. We're talking about a guy with an MBA from Wharton and 3 decades of experience. He was a total expert. For years, Rick spent hours every single day doing what he thought an expert was supposed to do, reading reports, researching stocks, you name it. But after he adopted a passive investing strategy, he had this huge realization. All that constant activity wasn't helping. It was just noise. It was actually distracting him from what really mattered, both in his portfolio and in his life. This number is just staggering. After Rick made the switch to a passive strategy, he actually calculated how much time he got back in his life. It added up to 6 full weeks per year. Think about that. A month and a half of his life every single year that he was no longer wasting on stuff that didn't work. Time he could now reinvest in his real life. So all of this, the jar, the doctor, the expert, it all brings us to the final and really the most important question, because this whole story is really about you. This is the question that everything boils down to. It's a moment to just pause and reflect. What are the core, non-negotiable things that give your life its deepest meaning? Take a second and really think about it. And that leads us right here to the final crucial point. Time is the one resource you can never get back. The ultimate game isn't about beating the market. It's about living a rich, fulfilling life. So the question is, when you look at your own jar, are you putting the big rocks in first? Are you investing your most precious time in what truly matters? All right, let's dive right in. Today, we're going to explore an investment philosophy that completely flips the script on the whole reason we invest in the first place. This isn't about chasing hot stocks or trying to outsmart the market. No, this is about something much bigger, using your money to build a genuinely richer life. And it all kicks off with this really powerful thought from the author. You see, his greatest pleasure wasn't about the financial returns. It was hearing from people that the quality of their lives had actually improved. That right there sets a totally new benchmark for success, doesn't it? It's not about the number in your account, but the quality of your own day-to-day well-being. So that brings us to the core question we're really digging into here. What if the real point of all this investing stuff wasn't just piling up wealth, but actually enhancing your life? What if your strategy could bring you peace of mind instead of, a whole lot of stress? Okay, first things first. Before we get into the how, we have to get really clear on the why. What is the real goal of investing, anyway? You see, the author's motivation wasn't to be some kind of guru with all the secret tips. It was simply to teach, to arm everyday investors, people like you and me, with the knowledge to make smart, prudent decisions for ourselves, and then have the confidence to stick with them. It's all about empowerment, not making you dependent on someone else. And this leads to a really powerful metaphor that you are going to hear a lot about, the big rocks. So what are they? Well, they're the absolute non-negotiables in your life. We're talking about your family, your health, your passions, your community. The whole idea here is that your financial plan should exist to support these big rocks, not distract you from them. But if the goal is so simple, why is it so darn hard to do? Well, that brings us to the conflict in our story. These really powerful forces, both outside of us and inside our own heads, that are constantly trying to pull us off course. And you can really see the two paths right here. On one side, you've got Wall Street's game. It's exciting, it's loud, it's complicated, and it's always demanding you do something. And then on the other side, you have a prudent plan. It's calm, it's simple, it's focused on your goals, and it's all about discipline. These two things are, well, they're fundamentally at odds with each other. So the real challenge, the trick to it all, becomes tuning out all those distractions. First, you've got the noise of the market. The daily ups and downs, the breathless breaking news. And then you have what the author calls investment pandering, that constant stream of new products and can't-miss strategies designed to make you feel like you have to act right now. Now, take a look at this. It might look simple, but wow, is this important. As our overconfidence goes up, the cost of our mistakes doesn't just climb, it grows exponentially. Honestly, thinking you can outsmart the market is probably one of the most expensive mistakes any investor can ever make. So, we've identified the problem, right? We see the noise, we see the dangers. So, what's the answer? Well, that brings us to the prudent solution. The practical solution being proposed here is a strategy of passive and index investing. So, what does that mean? Well, forget trying to find a needle in a haystack. This approach is about just buying the whole haystack. It's designed to simply capture the returns of the overall market. And, this is key, to do it in a way that's incredibly low cost and tax efficient. So let's break down what this strategy actually delivers. First, you get market returns, which historically has been a super powerful engine for growth. You do it at a low cost, which means more of your money stays invested and working for you. It's tax efficient, so you get to keep more of what you earn. And when you put all that together, you get the most important benefit of all, the greatest possible likelihood of actually reaching your long-term goals. The financial benefits are pretty clear, right? But let's ask a deeper question. Beyond the numbers on a piece of paper, what is the real return you get from adopting this kind of philosophy? And this is where we come full circle. The ultimate return on a prudent investment strategy isn't measured in percentages or basis points. Nope. It's measured in the quality of your life. Just think about what this approach really gives you. It's not just a portfolio, it's a series of freedoms. You get freedom from that endless, stressful job of trying to follow the market every single day. And that gives you the freedom to put your time and your energy where it actually matters, on your big rocks. That means you have the freedom to do meaningful things and, maybe most importantly, the freedom to enrich your life by spending that precious time with the people you love. At the end of the day, that's what it all boils down to. The money is just a tool. A successful investment plan uses that tool to buy you back your single most valuable and non-renewable asset, your time. All right, for our final section, we're going to hit on what might be the most counterintuitive and maybe the most important idea in this whole thing.
And here it is. This is the core idea. Investing was never meant to be exciting. I know, right? Wall Street sells it as this thrilling, high-stakes game. But this philosophy argues that if your investing feels exciting, you're probably doing it wrong. The true purpose is actually much more sober and way more effective. It is simply to achieve your financial goals, whatever they happen to be, while taking the least amount of risk necessary to get there. It's about predictability and prudence, not about getting an adrenaline rush. Think of it this way. Investing is a tool, like a hammer or a saw. You use it to build something, in this case, your financial future. It is not meant to be a spectator sport that you watch for entertainment. The real goal is for the tool to just work, quietly and effectively in the background. So, how do you actually put all of this into practice? Well, the author boils this entire philosophy down into a clear, actionable framework of 30 simple rules. These rules are basically the roadmap. They're the practical how that follows the why we've been talking about. They're designed to keep you focused, to keep you disciplined, and to keep you on that prudent path to give you the best possible shot at reaching your goals. And so, we're going to end by turning the question back to you. Just imagine for a second that your financial plan was simple, automated, and basically taking care of itself. With all of that time and mental energy freed up, what big rocks, what truly important things would you choose to focus on in your life?
All right, let's jump right in. Imagine if you could distill 40 years of hard-won financial wisdom, the real lessons, into just the next few minutes. Well, that's exactly what we're going to do today. We are breaking down 30 rules for prudent investing, basically creating a clear roadmap to help you actually hit your financial goals.
The source material kicks off with this really brilliant analogy. Think about it. What's the real secret to living a long life? It's not some crazy, complicated biohack, right? It's the simple stuff. Eating well, moving your body, getting enough sleep. The core idea here is that investing is exactly the same. You don't need some impenetrable, complex strategy. What you need are simple, powerful rules that you can actually stick with for the long haul.
Okay, so here's our roadmap for this explainer. We're going to start with the big idea, the premise behind it all. Then we'll dive into what might be the most important part, knowing yourself and your plan. From there, it's all about strategy, how to actually build your portfolio. We'll cover how to avoid those classic mistakes, what the source calls the siren song, then talk about how to pick a guide for your journey. And finally, we'll wrap it all up by redefining what it really means to win this game.
All right, let's dive into that first part, the premise. Before we even get to rule number 1, it is super important to understand where all of this comes from. You know, this isn't just some abstract theory from a textbook. These are principles forged over decades of real-world experience.
We're talking about nearly 40 years of experience here. The author managed financial risk for pretty much everyone, from regular individuals to massive corporations. So the rules we're about to go through, they are the direct result of all that time in the trenches. This is wisdom earned straight from the financial front lines.
Now for the foundation. And this is so important. Because before you even think about buying a stock or a bond, the real work of successful investing has to begin. It all starts with a deep, honest look in the mirror, and then creating a rock-solid, durable plan you can count on.
So, let me ask you a question. Just pause and think about it for a second. With all the chaos and complexity in the markets, what do you think is the #1 reason, the single biggest culprit that causes well-intentioned investment plans to just completely fall apart?
And there's your answer. It's not about not being a genius. It's not about missing out on some hot stock tip. Nope. It is simply taking on more risk than you can actually handle. Because when things inevitably go sideways, and they always do, that's when fear kicks in, and that carefully crafted plan, right out the window.
So, what makes a plan durable enough to survive that fear? Well, first off, you have to write it down. It sounds so simple, but having it on paper creates discipline and helps you stay the course when things get volatile. It also needs to be connected to everything else, your estate, tax, and insurance plans. All your money should work together. And finally, and this is a big one, a durable plan focuses more on consequences than on probabilities. You don't just ask, what's likely to happen? You ask, what happens if the unlikely thing occurs, and can I survive it?
Okay, our foundation is set. We know ourselves, we've got a plan. Now it's time to actually build the portfolio. This part is all about the strategy, how to construct a portfolio that's truly resilient, one that can weather just about any storm the market throws at it.
Now, pay attention, because this is one of the most crucial distinctions in all of finance. The strategy to get rich, that often involves taking big, concentrated risks. But the strategy to stay rich, that's a completely different ballgame. It's all about playing defense. It's about minimizing risk and spreading your bets wisely through diversification.
And that leads us right to the single most important tool for managing all that risk. I love this metaphor. In the chaotic and uncertain sea of the financial markets, diversification is your safest harbor. It's famously called the one and only free lunch in investing.
So what does real diversification actually look like? Well, it's way more than just owning a few different stocks. It means spreading your investments across companies of all different sizes, large cap and small cap. It means balancing between different investment styles, like value stocks that are kind of like bargains, and growth stocks with huge potential. And crucially, it means going way beyond just US stocks to include different places, like international and emerging markets, and even totally different kinds of assets, like real estate, commodities, and good old-fashioned high-quality bonds.
Okay, now this next point is a little subtle, but it is so critical to understand. You always hear people say higher risk equals higher return, but that's not quite right. Taking on more risk does not guarantee you a higher return. What it gives you is a higher expected return. That's the potential for a bigger payoff. But believe me, there are absolutely no guarantees.
All right, so we've built our plan, we've built our portfolio. You'd think the hard part's over, right? Well, now comes the real challenge, navigating the journey without getting lured off course by all the noise. This section is your guide to avoiding the most common and most costly mistakes that investors make.
And here is the classic warning. I mean, think about it. Every single market bubble, every mania in history has been fueled by this exact phrase. It is the ultimate siren song that convinces smart people to abandon all discipline and chase the new thing, almost always with disastrous results. As they say, history doesn't repeat itself, but it certainly rhymes.
And here's the timeless adage that should be your ultimate gut check. You've heard it a million times, and for good reason. If it sounds too good to be true, it is. Period. In the world of investing, remember that the only proven free lunch is diversification. Everything else comes with a price tag, even if it's hidden.
I absolutely love this analogy because it is so vivid. That tempting, super high yield you see on some investment, that's the shiny red apple. It looks delicious, it looks perfect. But what Snow White couldn't see was the poison hiding inside. That poison is the hidden risk, and you often can't see it until it's far too late. Remember, a high yield is not the same thing as a high total return.
And here are a few more critical traps to sidestep. Be super wary of complex products. They're almost always designed to be sold to you, not bought by you. Don't act on public information. By the time you read a hot tip in the news, the market has already reacted. Remember that market bubbles can stay irrational way longer than you can stay solvent. Don't let the fear of taxes stop you from selling a huge winner to diversify your portfolio. And finally, please, avoid pure speculation on individual stocks. That's gambling, not prudent investing.
Look, trying to navigate all this on your own can be really tough. So let's talk about something incredibly practical: how to find a trusted advisor to help guide you on your journey. The absolute key here is to make sure your advisor's interests are perfectly aligned with your own. So first, try to avoid advisors who work on commission, because that can create a massive conflict of interest. Second, insist they act as a fiduciary. That's a legal standard that simply means they are required to put your interests first. And finally, for safety, separate the services. Use different firms for advice and for actually holding your money. It creates a great system of checks and balances.
And this brings us to our final and honestly most important section. After all of this planning, all this strategy and discipline, what's the ultimate goal? What's the destination we're all trying to reach? I think the answer just might surprise you.
So let's really consider this. After everything we've talked about, what is the whole point of this effort? What does winning the game of investing actually look like?
And here it is, the counterintuitive but profoundly important truth. The goal is not to outperform the market. It's not about beating some abstract benchmark like the S&P 500. Chasing outperformance is just another one of those siren songs that leads so many investors astray, causing them to take on way too much risk and ultimately fail to reach their real goals.
And this is the final powerful message that brings it all home. The real tragedy in all of this isn't underperforming a benchmark by a percentage point. The truly great tragedy is spending your one life obsessed with a chase that causes you to miss out on what actually matters. The real winner's game is using your money as a tool to achieve your goals and live a richer, fuller life. And that is a game worth winning.